Let me ask you something. How many times have you looked back at a stock and thought, if only I had known then what I know now? It's the worst feeling, right? In today's volatile market, that feeling can be especially costly. With inflation eating away at our hard-earned money, staying ahead of the curve is more crucial than ever. That's why today, I'm diving into 9 dividend increases that could be game changers for your portfolio and your financial security. Missing out on these could mean leaving money on the table, especially when these dividend boosts are not just extra cash in your pocket, they're your defense against rising costs. When a company hikes its dividend, it's like they're saying, we're not just surviving, we're thriving, and we want you to thrive too. But knowing which of these increases really matters is the key to making the right moves. If you're serious about protecting your wealth from inflation and avoiding those if-only regrets, you'll want to stick around. In the end, I'll show you a stock that's been increasing its dividend by 18% every year and how they've managed to do the same this year and quarter. All right, now that we've set the stage, let's talk about why dividend increases are such a big deal. You might be wondering, what's the hype? It's just a little extra money, right? Well, not exactly. When a company increases its dividend, it's sending a powerful signal to the market. It's like they're raising a flag that says, we're confident about our future and we're sharing that confidence with you. Think of it this way, a dividend increase isn't just a nice bonus, it's a sign of financial health and stability. Companies don't boost their dividends unless they're sure they can sustain those payments. This means they're not only doing well now, but they also expect to keep doing well in the future. For investors, this is a critical piece of information. It can help you identify which companies are worth holding on to or even adding more to your portfolio. But here's the kicker. Not all dividend increases are created equal. Some are small and might not make much of a difference, while others can have a significant impact on your returns, especially over time. That's why knowing which increases to pay attention to can make a real difference in your investment strategy. Up next, we're revealing the biggest dividend boosts ranked by how much each company has increased its payouts. Find out which stocks are setting the pace for higher returns. Starting at number 9, I have Illinois Tool Works with the ticker symbol ITW. This company has earned a reputation for reliability in the industrial goods sector, consistently rewarding its shareholders. This year, ITW announced a 7.14% increase in its quarterly dividend, moving it from $1.40 to $1.50 per share. On an annual basis, this raises the dividend from $5.60 to $6 per share. With 28 consecutive years of dividend increases, ITW is a model of consistency, demonstrating its financial stability and long-term commitment to shareholders. But what does this increase really signify? It's a clear signal from ITW's management that they're confident in the company's future, even amid economic uncertainties. Over the past decade, ITW's dividends have grown at an impressive average rate of 12.79% per year. This growth highlights ITW's strong business model and its dedication to providing continuous value to investors. Looking ahead, ITW is on track to achieve Dividend King status, a title reserved for companies with 50 or more years of consecutive dividend increases. This latest increase aligns perfectly with ITW's long-term strategy and further cements its position as a reliable choice for dividend-focused investors. Next on my list is Cummins, CMI, a company that continues to power forward with consistent growth. When it comes to reliability and power, CMI stands out in the industrial sector. This year, Cummins announced an 8.33% increase in its quarterly dividend, raising it from $1.68 to $1.82 per share. On an annual basis, this brings the dividend up from $6.72 to $7.28 per share. Just like one of their finely tuned engines, Cummins continues to power forward, showing consistent growth even in the face of economic challenges. Now, why is this important? Cummins operates in a cyclical industry where economic downturns can impact performance. Yet, over the last decade, the company's dividends have grown at an average rate of 10.39% per year. This consistent growth indicates that Cummins isn't just surviving the ups and downs, it's thriving and returning substantial value to its shareholders. Cummins has been increasing its dividend for 18 consecutive years, proving its resilience and commitment to its investors. In a sector where many companies struggle to maintain such consistency, Cummins has not only kept pace, but it has also set a benchmark for others to follow. From the engines that power industries, let's shift our focus to a financial giant that continues to demonstrate its own brand of steady growth: Bank of America Corporation. In the world of finance, few names carry as much weight as Bank of America. This year, the company announced an 8.33% increase in its quarterly dividend, moving it from 24 cents to 26 cents per share. Annually, this brings the dividend up from 96 cents to $1.04 per share. While the percentage increase might seem modest, it's a move that aligns with the bank's strategy of steady, reliable growth, a trait highly valued in the financial sector. Bank of America has managed to increase its dividend for 10 consecutive years, a period marked by significant challenges, including regulatory changes and economic fluctuations. Despite these hurdles, the bank has maintained a disciplined approach to capital management, ensuring a solid earnings base that supports continuous dividend growth. Why should this matter to investors? In an industry where some institutions have struggled, Bank of America has not only weathered the storms, but has emerged stronger, consistently rewarding its shareholders. With a 10-year average dividend growth rate of 9.86%, the bank has demonstrated its ability to generate consistent cash flows, which are crucial for sustaining and growing its dividend. Now, if you think Bank of America has done a good job in increasing its dividend, stick around, because in the end, I'm going to show you a stock that's been increasing its dividend by 18% every year, including this quarter. Next on my list, we enter the world of construction and mining with a company that's as solid as the machines it builds: Caterpillar Incorporated, or CAT. Synonymous with strength and durability, this is a company that many investors turn to when looking for stability in their portfolios. They recently announced an 8.46% increase in its quarterly dividend, raising it from $1.30 to $1.41 per share. On an annual basis, this takes the dividend from $5.20 to $5.64 per share. This latest increase is more than just a number. It's a reflection of Caterpillar's ability to navigate the economic cycles that define the construction and mining industries. Caterpillar's decision to raise its dividend is particularly noteworthy given the cyclical nature of its industry. The company's performance is often tied to broader economic conditions, yet it has managed to deliver 30 consecutive years of dividend increases. This level of consistency is a hallmark of a company that knows how to manage both good times and bad. The average dividend growth rate of 7.82% over the last decade is a clear indication of Caterpillar's ability to steadily return value to its shareholders even in a challenging market. Caterpillar's latest dividend increase is very much in line with its historical performance. The company remains on track with its long-standing commitment to shareholders, providing not just stability but also growth in income over time. One of the key reasons Caterpillar can maintain and grow its dividend is its strong cash flow generation, driven by its global reach and diversified product offerings. This allows the company to weather economic downturns better than many of its peers, making it a reliable choice for dividend-focused investors. The company's long history of dividend increases even during economic downturns makes it a dependable choice. So if you're looking to add a blue-chip stock with a reliable dividend to your portfolio, CAT should definitely be on your list. Next on my list is Morgan Stanley, or MS, a leader in investment banking and wealth management. They've recently caught the attention of income-focused investors with their decision to increase its quarterly dividend by 8.82%, raising it from 85 cents to 92.5 cents per share. On an annual basis, this brings the dividend from $3.40 to $3.70 per share. What's impressive about Morgan Stanley's dividend growth is not just the numbers themselves, but the context in which they're happening amid a competitive and often volatile financial landscape. In a year where many financial institutions faced significant headwinds, Morgan Stanley not only weathered the storm but emerged stronger, reflecting a staggering 10-year average dividend growth rate of 27.76%. This growth is a testament to the company's robust and diversified business model, spanning investment banking, wealth management, and institutional securities. For investors, this means that Morgan Stanley is not just a safe bet in turbulent times, but also a potential source of significant returns. The company's strategic focus on shareholder returns through both dividends and share buybacks highlights its commitment to enhancing shareholder value. At number 4, I have Goldman Sachs Group Incorporated, GS, a leading global investment banking and securities firm. Goldman Sachs has once again demonstrated its commitment to shareholders by announcing a 9.09% increase in its quarterly dividend. This increase takes the dividend from $2.75 to $3 per share, which on an annual basis boosts the payout from $11 to $12 per share. For a company renowned for its influence in global finance, this dividend hike is a clear indication of Goldman Sachs' financial strength and confidence in its business model. Goldman Sachs is often associated with high-stakes investment strategies and large-scale financial deals, but it's also a company that values returning capital to its shareholders. Over the past 12 years, Goldman Sachs has consistently raised its dividend with a notable 10-year average growth rate of 17.73%. What sets Goldman Sachs apart is its ability to balance aggressive growth with prudent financial management. The firm's diversified business model, which spans investment banking, asset management, and securities, provides a strong foundation for continued dividend growth. The latest increase not only rewards current shareholders, but also positions Goldman Sachs as a compelling option for those looking to invest in a company with both growth and income potential. Now we move on to the top 3. In the end, I'll show you a stock that's been increasing its dividend by 18% every year and how they've managed to do the same this year and quarter. So at number 3, we have Kroger Company, CR. Ever wondered how a grocery giant like Kroger keeps growing its dividends in such a fiercely competitive industry? This year, Kroger announced a 10.34% increase in its quarterly dividend, moving it from 29 cents to 32 cents per share. Annually, this brings the dividend up from $1.16 to $1.28 per share. What makes this increase particularly interesting is Kroger's ability to grow its dividend in an industry that's known for tight margins and fierce competition. Over the past 16 years, the company has consistently increased its dividend, reflecting a commitment to returning value to its shareholders. With an impressive 10-year average dividend growth rate of 13.69%, Kroger has proven that it can navigate the challenges of the retail sector while still rewarding its investors. What sets Kroger apart is its focus on long-term growth, even in the face of industry challenges like pricing pressures and evolving consumer habits. The company's ability to raise its dividend by over 10% this year is a clear signal that management is confident in its business strategy and future prospects. Kroger's latest dividend increase aligns well with its historical growth pattern. The company's strong performance in a competitive industry shows that it's not only maintaining but also enhancing its commitment to shareholders. This consistent growth suggests that Kroger is well on track with its long-term dividend strategy. Now at number 2, I have Marsh McLennan, MMC, a global leader in risk management and consulting. MMC recently made a bold move by increasing its quarterly dividend by 14.79%, raising it from 71 cents to 81.5 cents per share. This takes the annual dividend from $2.84 to $3.26 per share. Marsh & McLennan's dividend increase stands out not just for its size, but for what it represents, a company in a traditionally stable industry that's rapidly becoming more shareholder-friendly. Despite having only 3 consecutive years of dividend increases under its belt, MMC has managed to achieve an impressive 10-year average dividend growth rate of 11.08%. This demonstrates the firm's focus on enhancing shareholder value through consistent and meaningful dividend growth. One of the factors contributing to Marsh McLennan's ability to increase its dividend so significantly is its strong and growing cash flow. The company's diversified operations across insurance brokering, risk management, and consulting services provide a stable revenue base, allowing for continued investment in growth while also rewarding shareholders. This blend of growth and stability makes MMC an intriguing choice for dividend investors. And now, finally, topping my list at number 1 is Jefferies Financial Group Incorporated, or JEF. Jefferies Financial Group Incorporated may not be the first name that comes to mind when you think of dividend-paying stocks, but this diversified financial services company has been making waves with its recent dividend hike. Jefferies stands out in the financial sector due to its strong focus on capital returns. Despite being a smaller player compared to the big banks, Jefferies has managed to carve out a niche for itself, offering substantial value to its shareholders. Over the past 7 years, the company has consistently increased its dividend, boasting an impressive 10-year average growth rate of 18.38%. This rapid growth is indicative of Jefferies' solid performance and strategic initiatives that drive profitability. Recently, the company announced a significant 16.67% increase in its quarterly dividend, raising it from 30 cents to 35 cents per share. This change brings the annual dividend up from $1.20 to $1.40 per share. What's particularly compelling about Jefferies is how it balances growth and shareholder returns. The company has been able to significantly increase its dividend while also investing in its core businesses, ensuring that it remains competitive and poised for future growth. This dual focus on growth and returns makes Jefferies an intriguing option for dividend investors. Jefferies' latest dividend increase is a continuation of its aggressive dividend growth strategy. The company is clearly on track, not only maintaining its growth but accelerating it. This level of dividend growth is uncommon in the financial sector, making Jefferies a standout choice for investors seeking high growth in their dividend income.